Hello, class, and welcome to the Chapter 8 sample problems on cash and internal controls. So I'm going to start off with, for the sample problems, the very first problem I'm actually not going to do. This one is just strictly definitions out of the textbook. So I would like you to go out and pull these sample problems up and work on them. They address some key aspects of internal controls and cash controls and the types of activities that companies might undertake in order to establish internal controls within the company. I do want to just really quick call out some elements of internal control that you'll learn about throughout your career in business. And so the elements of internal control as they were established by COSO, the Committee on Sponsoring Organizations. There's an acronym called CRIME, which is the elements of internal control. The acronym stands for control activities, which are the systems and activities that occur in order to maintain control of assets and financial reporting within a company. The second is risk assessment, which is determining how the operations of the organization and all of the elements of the control environment and the systems that are in place come together to create a risk level for the company. The third one is information systems and communications. And that basically encompasses how the company gathers information together and communicates it out to those who need it and to those who are in charge of implementing controls over the organization. M is for monitoring, which is how do we keep track of things that are recorded in our financial system and keep track of our assets, and so that we are looking at the information that is created and determining if things are being recorded correctly, or if there are thefts that are occurring. And then the last is the environment, the control environment, which is like, what are the surrounding circumstances within the organization? This one is actually sort of the most important one and should be at the top, except the acronym puts it at the bottom. So the control environment is the tone at the top, the standard of ethics that is implemented within an organization that determines how all of these other items happen. So does the management within the company implement control activities to keep track of assets? Do they perform risk assessment to determine if there is a risk of fraud or financial error occurring? Do they put systems in place to track information and communicate it to those in charge of governance? And do they monitor everything to make sure that everything is in compliance and being kept track of? So I just wanted to call those out really quick since they're so important to this chapter. Moving on to problem 2, though, so make sure you check on those terms from the textbook. You should be able to like search them up in 30 seconds from the chapter. Now, looking at what happens when we have cash that comes into a company by mail. All right, that's what this question is discussing. The first thing that happens is the mail comes into the company and you have a mailroom employee who is going to be opening the mail, okay? So mailroom employee, first step, they're opening the mail and they are sending customer checks to the treasurer, who is the person in charge of managing the cash overall within the organization. All right, so the next one you can probably gather from the first step. So the treasurer or the cashier, sometimes depending on who does it directly in the organization, deposits those customer checks in the bank. Okay, so one person opens the mail. They probably have a lockbox room where they're not allowed to bring in bags, things like that. And they may have camera observation in that room, or they may have people working in pairs so that somebody can't steal stuff. They pass the checks and cash on to the treasurer to deposit. After they are deposited, the treasurer provides a remittance slip or deposit slip to the accounting department, who uses those to record journal entries for the cash receipts into the accounting system. Okay. And then after that, the controller compares the bank deposits, so the money that actually went into the bank, to the journal entry that was made by the accounting department, to make sure that the what went into the bank, the banking records that are generated by the treasurer making deposits, match up with the recorded transactions that were recorded by the accounting department. Okay. Now, normally, a control that might happen here, because you could say, hey, well, what prevents the treasurer from lying about what they put in the bank, right? How does that work? Well, this mailroom employee, when they are opening the mail, they're actually making a list of all of the checks that come in and need to be deposited. So they have a copy of that list of checks that they provide directly to the accounting department. We're not relying on the treasurer taking the checks and providing the information. That information gets duplicated by the mailroom employee so that we have whoever is given those checks to deposit out of the secure room, somebody else has created a record that gets sent to the accounting department. So one person has physical custody, the treasurer, to deposit the goods or the checks, and then the accounting department has the record of what needed to be deposited as well, so that they can match that up to, so that the controller can ultimately match what is recorded in the system by the accounting department with what went into the bank. All right, for problem 3, we are just looking at some terms that are related to cash receipts, like what are the documents that are involved here. So a vendor sends inventory to a company. So that's the person that you're buying your stuff from is a vendor. And the vendor sends both the inventory and a bill called an invoice to the purchaser. And that invoice is a demand for payment for the goods that were purchased, or services for that matter. Now, after approving all documents, the person who purchases the goods sends a check as payment to the vendor. Now, it could be a physical check that goes out in the mail. A lot of companies, especially larger companies now, are shifting to direct deposit for vendor payments. So they might get a bank number account for the vendor and direct deposit a check into the vendor's checking account, which saves money on mailing costs. And it also is like a faster thing that you can process. So less time for the purchaser to process the payments, and the vendor gets their payment more promptly. So everybody is happy. Next, when ordering merchandise inventory, the purchaser sends a purchase order to the vendor. So if I decide that I need a bunch of stuff, I will get a purchase order approved in my organization that will be sent to the vendor requesting that we purchase those goods. So that's basically the purchase order gets approved by somebody above the person who is requesting the goods within the organization. And the number of people who have to sign off on that purchase order will vary based on the size of the purchase. So the larger the purchases that a company wants to make, the more people within their company need to sign off on it and be like, yep, we approve of purchasing this stuff. Once it's fully approved, the purchase order gets sent to the vendor for fulfillment. All right, and then the last item, the purchaser receives the inventory. So if we've sent the purchase order off, the vendor ships us the inventory with an invoice. And then when we receive those goods, we prepare on our end, the receiving end, a receiving report showing that we received the goods. And then what happens in our accounting system is that we will have, so we've got the invoice, right? That was received. We've got a purchase order that was sent out to the vendor, right? So from vendor. here, this purchase order was sent to the vendor, and we created it prior to the purchase. So that's our approval, right? And then we have a third item here, this receiving report, which we generate when we receive the goods. And if we have a huge company, this receiving report might be prepared by somebody like in a warehouse who's receiving these goods, or an administrator who's receiving like office supplies, things like that. Some person who's specifically in charge of tracking things that come in. And so this is what's referred to as a three-way match. And this is used in most large companies to approve payments that are generated. So once they would have this three-way match, that would be when they would approve payment on this invoice that was sent. Okay, so the accounts payable group is going to go in, they're going to enter in this invoice into the accounts payable system. Then they're going to log and check off, oh, here's the purchase order for it, and here's the receiving report. Check, check. We've got our three-way match, and then payment is issued. So that is how that process works. And that would be an internal control then, because if, for example, they receive fewer items than they ordered, then they can compare that to the invoice and say, oops, we only received like 7 out of the 10 items that we requested. So we will issue a payment only for 7 out of 10 items. All right. And they are not going to issue a payment until the other 3 items are received. But they will still check and make sure that all 7 items were on the purchase order. Or let's say I ordered 7 items and I actually received 10 instead. Then we might double check and see if we get a retroactive approval for the additional 3 items, in which case we would match up that revised purchase order, or we return the extra 3 items. Either way, we can only approve payment for the items that we actually have a purchase order for and that we've received and that we were invoiced for. Okay, so next problem we've got here. We are going to record some cash receipts. So we are a company that receives both cash and credit cards. And in most cases, we will record receipts through credit card companies as if they are a cash receipt, because usually if you're set up with a credit card company to receive credit cards, you will receive that cash into your checking account within 1 to 2 days of people paying with a credit card. So we would look at our credit card records for the time period and just record, okay, here's what we have received, or here's what we expect to receive. So we have a company that accepts credit and debit cards as forms of payment, and they've got 12,000 of credit and debit card sales on June 30th. Now, when they receive their credit card receipts from the bank, there's 2 ways that this can happen, right? Sometimes the credit card company will send all of the receipts in a lump all together, and then later they will charge you a fee for the whole month. All right. And in that case, you would record the entire cash receipt as soon as those credit card amounts are identified in one lump sum. All right. Now, in other cases, they don't send you the total receipt. They will send you the credit card receipt, but they might subtract out the fees. So let's say if I had $1,000 in credit card receipts and there was going to be $50 in fees, the credit card company might just send me a payment for $950. So in our first problem that we've got here, that's kind of the type of example that we've got. We've got a company that is going to send us the credit card receipts net of 2% of fees. So we need to record cash here that we're going to receive, but it's not going to be the full amount. So ultimately, though, what we're supposed to get here is $12,000, right? So that's our sales revenue. Either way, we're going to get $12,000 in sales revenue, but we're going to get less than 12,000 in cash. So we're going to have credit card expense for the part that goes straight out as a fee. So what we need to do then is figure out what is the amount we're going to receive. So we've got our calculator here. Let me clear this out. So we have got $12,000 and the amount of fees that we're going to pay is 2%. So we're going to pay $240 in fees here. All right. So that means that the cash that we're going to get is going to be $12,000 minus 240, which is going to be $1,160. So 12,000 minus the 240 fee, which is the 2% that they told us about. So that's if we are recording our credit cards sales and our receipts are going to come net of the fees. Okay. All right, now, if we have a company that's going to give us the whole lump sum up front and then charge us the fee later, then we would record this under the gross method. So we're just going to, in that case, all we're going to do is record $12,000 in cash, and we're going to record sales revenue for $12,000. So just like a regular cash receipt. So that'd be just recording your credit card sales. Okay, so difference, whether the fee comes out now, whether the fee comes out later. And you might sometimes, one credit card company you have, like your Visa and MasterCard processor, might send things gross, and your American Express company that processes those type of cards might send it net of fees. So usually companies will kind of record it based on how it comes into their checking accounts. All right. Now, our next sample problem related to cash looks at a ratio that judges how able are we, based on the amount of cash we have, to pay for our current liabilities. So this is referred to as the cash ratio. So the ratio for cash is calculated by taking your cash and cash equivalents, which is cash, any credit card receivables that you have coming in, and any other items that you can convert to cash easily, like money markets or cash funds that you might have for investments, where you can get the funds within like 48 to 72 hours. You might refer to those as cash equivalents because they're so close to cash that literally you just have to make a call or go online and request a withdrawal. So those would be treated just like cash because you can get them quickly. So we take cash and cash equivalents, and then we divide those by our total current liabilities to get our cash ratio. So they actually provided us with our cash and cash equivalents, so we don't even have to calculate it. It's going to be $60,000 divided by the $75,000. Whoops. And that gets us to 0.8 for our cash ratio. So that means that right now we've got 0.8 of cash in relationship to our, so 80 cents of cash for every dollar of current liabilities that we have. So we can pay the vast majority by just writing out checks right now. And then the rest we would probably pay for with accounts receivable, like, so we're waiting for funds to come in and or inventory that we expect to sell in the near future, hopefully. All right, and that brings us to our last and most complex question that we have here, which is a bank reconciliation. So one of the control activities that a company can do is what's referred to as a bank reconciliation. And what that means is they get their bank statement and they compare what is in their bank statement for transactions to what they have recorded in their accounting system for transactions. And then they make sure that all of the items that they have in their bank statement have been recorded in the accounting system. And then they also look and say, all right, if we look at everything recorded in our accounting system, and we remove the items that have not gone through the bank yet, does our accounting system balance match what is in the bank? All right. So looking at what we've got here, we've got a list of transactions that are recorded in our cash account. And notice this is a T account. So we've got debits or increases on this side. We've got credits or decreases on this side. Now, over here, we have a copy of a sample bank statement that is out there. Okay. So the sample bank statement here is dated February 28th, shows an ending balance of $3,070. Now, this balance only includes items that have cleared through the checking account. So we might have written out a bunch of checks that we've sent out to vendors and they haven't deposited them. So there could be checks that still need to come out of this that would match up that we have in our accounting system that have not been recorded by the bank yet. Also, depending on how quickly our bank processes things, we could make a deposit, say like in the evening or right at the end of the day, that the bank considers not deposited yet, and they'll clear it into our account tomorrow. So those items that have not gone through are considered deposits in transit or outstanding checks, okay? So we're going to go through and we're going to look at, okay, how do those compare to what we have in our system here? So what we would do, I'm going to take a marker here and I'm going to highlight some stuff. So let's do this. We've got a highlighter. I'm going to look at this and say, all right, these are the items I have here in my list of checks. I've got, oops, and I got to be able to scroll here. Hold on. So let's move this over. I got to scroll down. So if I scroll down here, I've got deposits and I've got a service charge and I've got checks that are out here, right? And I've got my highlighter. So I had deposits on this side. So I have a deposit for 800, which is here. I've got a deposit for 1,800, which is here. I've got a deposit for 1,100, which is here. And I've got a deposit here that looks like it's not recorded in my system. So I'm going to need to make a journal entry to record that item. And then over here, I've got a deposit for 2,400, which is in my system, but has not cleared over here yet. So this would be considered an outstanding item. Okay. So I'm going to really quick here. I'm just going to make a list of outstanding items here on Excel. Let me pull this up. It's taking a second. Because as soon as I move these things, I'm going to lose my window. So I'm writing this down here in Excel, and I'll move this Excel window over here in a second. So outstanding items. I'm going to record a deposit for $2,400. And then I'm also going to make a list of items to record. All right, so EFT deposit for $1,000. Okay, so this is just, oops, here we go. This is what I've got that I'm putting together here. So I'm just going to keep adding these things, and I'll pull this out later where you can see it in a second. In the meantime, I'm going to keep highlighting here. Okay, so on the check side of things, I've got a check for 400, which is cleared, a check for 3,100, which is cleared, a check for 1,100, which is cleared. And so these two checks, it looks like, have not cleared. So I'm going to add those then to my list of outstanding items. So I have a check for 500 that has not cleared, and a check for 900 that has not cleared. All right. So those are right on my list now. And then the other thing that I've got going on here, looking at my bank statement, I've got two things that came out of my account here that are not showing up in here, right? So I've got an EFT, so a funds transfer for rent for $330, and then I have an NSF or non-sufficient funds check for $700. So I need to make journal entries to record those also. So this is what a real life bank reconciliation looks like. Okay, so I've got these. I'm going to now clear my things that I wrote on. Oops, and I'm sorry, I've got a service charge here also. All right, so I'm going to need to record that too because that's not here. All right, so I'm going to clear my writing, my highlighting here, and I'm going to move these over so that I can bring my Excel over here and keep an eye on this. And then I'm going to make this window narrower so that I can see it with my Excel next to it. There we go. All right. So looking at what this, so now we're going to put together a bank reconciliation. So first what we have to do is figure out our adjusted bank balance, which says, okay, if we take this bank balance that we had on the bank statement of 3,070 and we adjust it for these items that haven't cleared yet, what would the bank balance be if we included these items that are not on the bank statement? So we're going to start off with our balance on February 28th here, which is the $3,070. And then what we're going to do is we're going to add in our deposit in transit. So if this deposit had cleared for 2,400, we would then have, let's see, so 5470, right? So 5470. And then we're going to subtract out our outstanding checks, which we have here for, so issued, let's see, hold on, when were those issued? The 23rd and the 28th, or no, I'm sorry, 25th and the 27th are the checks. Okay, so issued February 25th and issued February 27th. They were 500 and I don't know where that's coming from, 900. So we have $1,400 in outstanding checks. So if we had 5470 and we subtract out these outstanding checks, that's going to get us to $4,070. And that is our adjusted bank balance as of February 28th. Okay. So now we've got an adjusted bank balance, and now we're going to look at our books, and we're going to start off with on our accounting balance here, we had $4,095, and then we're going to consider these items that we didn't have recorded yet, that we didn't know happened, and what would this book balance look like if we recorded those items. So we've got our balance as of February 28th, which was, again, $4,095 from right here. All right, and then we're going to add in this EFT deposit that we collected. So let's see, bank collection of note receivable, okay. And then that gets, let's see, let me look at this bank statement. Was there anything else? Oh, that interest item. I did not record that here. Whoops. Interest income of $15. Okay, so I got to record that too. So interest revenue earned for $15. So we had, it's pulling in something weird there. I don't know, $1,015. So when we add that together, that gets us to $5,110. All right, now we need to subtract out these three items, which cleared on the bank, but we did not have recorded in our system. So we have EFT for rent, which was $330. We have a service charge for $10. And then we have this non-sufficient funds check for $700. So a total of $1,030, $1,040 when we add those three things together. So then we're going to take this book balance here and we're going to subtract out these items that we need to record. Okay. And so So $4,070 is what we have there. And so $4,070 is our adjusted bank balance, or I'm sorry, book balance there. So now if we look at this, by the way, your bank reconciliation is considered to be reconciled if your adjusted bank balance matches your adjusted book balance. And what that means is that everything that has cleared on the bank is in our system, recorded somewhere. And when we take our bank balance and we consider items that have not yet gone through what the bank says should be there, if we were to consider those items, agrees with what is in our accounting system. Okay, so that's the nature of a bank reconciliation. And so that means that if somebody steals money out of our account, we notice it and we can report it. It also means that if we have errors on what we've recorded versus what cleared the bank, we can find those errors and fix them. And it's a control to make sure that people can't just take money out of there without anyone noticing that it's gone. All right. And it also means that when we look at our accounting system and say, hey, how much money do we have? It actually matches what we have in assets in the bank. Now, the last step with your bank reconciliation is we've got these items that we recorded. We have to create journal entries to record these. So we're going to go through here. This additional $1,000 here for collection of a note receivable, we need to record that cash receipt. So we're going to debit cash for the $1,000 that was received, and we are going to credit note receivable for that. So we had an asset on our books for money that somebody owed us for $1,000 or more, maybe. And they sent us a payment on it for $1,000. So we're going to reduce down that note receivable that we had on our books. So note receivable collected by the bank. And then the next thing we're going to do is we're going to record the interest that we earned for $15. So we received cash for $15. So we're going to debit cash for that. And then that's going to be interest revenue. So crediting interest revenue, because all revenues are credits. All right, so that is interest earned on our bank balance. All right, now the next thing we're going to do is we have to record the bank service charge of $10. So that's going to be a decrease to cash. So we're going to credit cash. We're going to debit our bank expenses here for the $10 fee that we had to pay and credit cash. So reducing our cash. And then that's going to be bank service charge right there. All right, the next thing, journalize the non-sufficient funds check that was returned from a customer. So we made a deposit into the bank. Our bank sent the check that we deposited to the customer's check, and they didn't have enough funds. They had non-sufficient funds in their checking account to pay for it. So the bank said, we're not going to pay that. And they sent it back to us. And then our bank said, oh, you deposited this, but they said no. So we're yanking it back out of your account. So that is what an NSF check is when the customer writes a bad check to us. So what we're going to do then is we're going to record the account receivable and put it back in there for the $700. So we're going to debit accounts receivable here. So they paid us, and when they paid us, we would have debited cash and credited accounts receivable for the amount that they owed us. Now we're just putting it back in their account saying, by the way, you still owe us this money. So we can keep sending them bills for that. All right, so we're crediting cash then, and that was $700. That was quite a check that they. And so for this one then, that's going to say NSF check returned by bank. All right, and then the next one is the rent payment that we had pulled out automatically. So this one, we're going to be, again, this was a reduction in cash. So we're going to credit cash. we're going to record rent expense for this for 1 month of rent. Yep. And that will be a monthly rent expense. Okay. And so you do your bank reconciliation first so that you can come up with a list of these items that you have to record. And then you go back here and all of these items that you had to adjust or in your book balance to arrive at what was in the bank, all of those items you have to make journal entries for so that your books, your accounting system agrees with what has gone through the bank. And that is how we do a bank reconciliation. So that is the last sample problem for chapter 8. Please let me know if you have any questions. Thank you.